So, we have three of our very best analysts here presenting you today. Indeed, these are our market and our insight leaders. Mark Adioson, Teresa Wilkie, and of course, Terry Childs. Mark's been with Westwood for about a decade now, specialising in offshore. Teresa similarly has over a decade of experience, 6 years of that just with RigLogics. And of course, Terry, well, I suppose Terry doesn't really need an introduction, does he? But 35 years plus writing about the rig market is really something. Also today, our wider team is here, including David Linden. Where are you, David? There he is. David's head of energy transition, just back from the ACP Offshore Wind Power event. Please feel to grab him. And also Ernest, who joined us more recently, is at the back of the room there, our business development manager. If you need us, we've all got blue badges. There'll be some time afterwards to chat as well. So, what can you expect to hear today? Well, Mark's going to kick things off. He's going to be taking us through the optimism and associated challenges that the offshore EPC market has experienced year to date, while also highlighting our forecast through to 2026. With Brent oil prices averaging $70 a barrel over 21 and 104 over the first 9 months of 2022, it's sort of been a dream come true to a point for the industry, but it is slowly becoming a more difficult situation for operators. Going too far too fast definitely comes with a lot of associated risk. Following on from Mark, Teresa and Terry are going to pick up to look at the global and Americas offshore rig market. And the global offshore rig market, of course, is now the recovery well underway. And as you're going to hear, there are several positive indicators to back this up, such as rising utilisation, day rates, awards activity. And then the regional Americas market is, of course, proving to be one of the most significant in terms of drivers of demand, particularly in floating rigs. And of course, meanwhile, emissions reductions efforts within the offshore rig segment are not showing any signs of slowing down. And I think several contractors are now starting to set targets, investing in energy efficiency and reduction systems. Teresa's working on a very interesting report around rig emissions for our clients that are here, so watch out for that. So there's some extremely interesting slides coming up. First, if you'll just indulge me for a few minutes, as one would expect. There's many familiar faces here today, but also there's many that aren't and perhaps not quite familiar with Westwood. Who are we and what do we do? Well, we are a trusted, established and leading research analysis group covering key energy sectors. We really scrutinise and interrogate parts of the energy system that we feel others don't. We try and dig deeper, we try and reach further, we try and join up unconnected data that gives you a quantitative and qualitative insight that you can act on, hopefully, pretty much immediately. Because the energy landscape is changing. And Westwood, and us, individuals, people, we're evolving as well. We're trying to evolve in step so we can answer some strategic, commercial and technical questions that all of you are going to face, sometimes every day. So as you can see from this slide, we offer a range of access points to that data and insight, markets, products, and just to highlight this point about evolving, we've recently launched new energy products and of course WindLogics, particularly on the WindLogics side if you're looking at the earlier stage in terms of commercial lease data. Like I say, feel free to reach out to any of us whilst we're here. We cover the offshore market really in four main areas. We're going to speak to three of those today, so I won't linger on this. Lastly, from me, everything you see and hear and after the session is derived from our product solutions. RigLogics is a very bright slide, but a very useful slide nonetheless. Subsea logics and platform logics. that's the coverage in terms of what you're going to be presented with today. We're all around to do demos. Indeed, if you scan the QR code, you've got an option there to say, tell me a bit more. So, that is it from me. I'd like to welcome Mark up to kick things off. Thank you.
Thank you, Gareth. Microphone working?
Yep.
Okay, good. Thank you. So I think it's good to pick up from where Gareth stopped in terms of the optimism we see in the marketplace. I think at the beginning of the year, as the chart on the left-hand side of the screen will show you, we were forecasting about $82 billion in offshore EPC spend. However, that optimism is becoming more or less half-achieved, semi-reality in a sense. And we've seen a bit of a downward revision of about 18%, which is approximately 16 billion of EPC award value have either been cancelled or delayed by operators as they continue to evaluate project economics. Year to date, 35 billion of EPC spend have actually been sanctioned, with an additional 31 billion expected in the fourth quarter. So probably Christmas comes every week in the fourth quarter. I believe earlier today, Saipem actually announced is won the largest single offshore EPC contract on its record with the not fueled compression project valued at 4.5 billion. So we expect to see more of that for the rest of this quarter. So which means we're more or less on record to have an expenditure for EPC activity that trumps what we've seen since 2014. And other major projects that we expect to be sanctioned in the fourth quarter, driving the spend, is going to be another North Field project, which is North Field South. Some letter of intent have already been issued on that one, and we expect the full EPC contracts to be awarded. Shell's Gato do Mato is another project that we're monitoring. We expect that to also get sanctioned before the end of this year. Obviously, there's been a limited notice to proceed that's been issued to the front runner for the FPSO. Another project that we're monitoring at the moment is going to be in Western Europe, which is going to be Equinor's Western project. We expect that could be delayed beyond this quarter, but most likely would happen before the end of this year. Also, Aker BP's New Aker project is another one that we're monitoring as well. In West Africa, we're looking at the PAJ field, formerly operated by BP, and that's going to be Azul Energy. And we anticipate that could possibly happen before the end of this year or in the first half of next year. So if you look at the chart on the bottom left-hand side of the screen, you can actually see the count of FIDs year on year, quarter on quarter. And what we are seeing right now is a very balanced market in 2022 when you compare that to 2021. However, we're anticipating a significant increase in 2023 in terms of planned FID. But as always, we always treat some of these numbers with caution, as some projects do get delayed along the line. However, in the fourth quarter of this year, we are anticipating approximately 29 FIDs to support the expenditure that we saw in the previous slide. And that would also add to the 52 that we've seen year to date, quarter on quarter. In Q3 specifically, we recorded 15 FIDs, and that was driven by ADNOC's Elang Gasha project, Shell's Jackdaw in the UK, as well as the Rosemary Marjoram in Malaysia. It's also interesting to see Petrobras moving forward with the expansion of the Buzios project. So 3 FPSOs have actually been awarded this year for phase 9, 10, as well as 11, with 11 recently sanctioned just about a couple of weeks ago. In the Middle East and Asia, we expect to see a lot of brownfield activities supporting the expenditure, as well as a lot of the FIDs that we are recording in our numbers. So the demand for SURF would always follow the trends for subsea trees. So as you can see there, Latin America would be dominating the market when it comes to subsea tree demand over the 2022-2023 period. However, if you also look at the SURF market, we see a lot of subsea power cables also supporting expenditure and activity in Western Europe. So looking at the near-term subsea tree opportunities over Q4 2023 to Q3 2024, we can see that a lot of the opportunities continue to remain in the Atlantic margin. However, major project in the UK North Sea expected to be sanctioned over the next few quarters would be some infield activities at BP's Shellion project, as well as the Scarv satellite project. Whilst the East Coast CCS project is also expected to account for at least about 6 subsea trees over the next couple of years. In the Mediterranean, we expect Chevron to sanction the next phase of the Leviathan project, and that's expected in 2024, while the Aphrodite gas project offshore Cyprus is also expected to be sanctioned. However, we anticipate that is going to be post-2024. When you look at the Atlantic margin, it's quite obvious opportunities in Guyana with the Oruru project expected in 2023, while Longtail project, we anticipate that is going to be in 2024. And both of those projects will be accounting for well over 100 subsea trees over the time period. Equinor is also going to be part of the top 3 operators demanding subsea trees over the time period that we are analyzing, and that is going to be driven predominantly by Rosebank, as well as the Bay du Nord project. Now, those are currently expected in 2023 and 2024 respectively, but there are potentials for delays on each of those projects. So letting the numbers actually tell us more of the story, I think there's been a lot of talk around supply chain challenges. There's been a lot of talk around inflationary pressures. And what you can see here is a quick run on our data to see the average subsea tree EPC spend per FID. And you can see over the 2017-2019 period, there was a relative stability, and you can see the impact of COVID when you look at the 2020 numbers. But looking at 2022, there's been a significant spike there, and obviously, as I mentioned earlier, in terms of subsea power cables, that is also driving up some of the development costs in Western Europe. We anticipate that in 2023-2024, there'll be a slight decline in inflations that we've actually seen so far this year. And that slight dip is expected to support some of the projects that have been delayed, as shown over a couple of slides ago, and we anticipate that we, at the end of the day, support expenditure. Moving on to the next slide, which is a quick overview on production platforms. We anticipate a total of 79 FPS units is expected to be sanctioned over the 2022-2026 period, and that would include 37 new build units, 27 conversions, while 15 units are expected to be upgrades or redeployment. As expected, Latin America is going to account for 30 of those units, which is about 38% of the market, and 8 units is expected to be sanctioned in North America. And that is going to be 5 units will be FLNG units. 2 of those are going to be for Delfin FLNG, with the first unit expected to be sanctioned before the end of this year. And 1 unit, which is going to be for the Cedar LNG project, offshore Canada, as well as the Insiga Nation, which is also in Canada. So activities are expected to rebound offshore Africa, as you can see, with the region accounting for 19 units over the forecast. And 10 of those are going to be new builds, 4 will be conversions, while 5 will be upgrades as well as redeployment. And one of those redeployments is going to be for the PAJ field, as earlier mentioned. Project financing is becoming much more difficult and becoming a big issue, especially with large FPS projects. And that's why we anticipate some delays in some of these projects. As we've seen in 2022, we anticipate that is going to continue over the next couple of years as operators continue to negotiate for better commercial terms. However, we are beginning to see that funding for this project is becoming much more difficult for FPSO contractors, as the Export Credit Agency in Europe is no longer available for project financing for such. And other financiers are actually seeking very short loan period, which surely puts some of this project at risk. And if you look at the fixed platform chart, what we expect is over the 2022-2023 period, activity is going to be predominantly driven by expansion projects in Saudi Arabia as well as offshore Qatar. A lot of expenditure going into the Safanaya project, the Zuluf project, as well as the North Field expansion. But beyond that, we see a significant drop after this heavy level of investment, and there will be trickles of smaller projects, especially in Southeast Asia. So that said, looking quickly into the FPS market, just to highlight some of the things that we are seeing in the marketplace today, we anticipate that over the next 5 years, the capacity of FPS throughput to be sanctioned is going to be record levels with about 8.3 million barrels of oil equivalent per day over that time period. And even year to date in 2022, we actually already see the highest throughput capacity sanctioned with 1.9 million barrels of oil equivalent already sanctioned. We estimate that some of these projects will be the ones that we've seen already in Latin America, while other regions would rather go for a more standardized FPS project. You can also see in terms of the market sizing over the time period, Latin America continued to gain market share with the region expected to account for 67% of new capacity sanctioned over the 2022-2026 period, and that is in comparison to the 2012-2016 period, which just indicate 40%. So despite those challenges of project financing, project delays, we've seen 2022 coming out trumps, even above the 2011-2012 period, and we anticipate that record would continue as demand for oil and gas continues to grow. Now, a quick look into specific region, and I've actually just split this into, I would say, 3 main regions. And the first one we're analyzing today, that's going to be the APAC region. And here we can see in that region, 18 FPS units is expected over the forecast period. However, fixed platform activity will continue to dominate that market. Obviously, that is due to the nature of development within the area because it is predominantly shallow water development. And the number of FPSOs that we've actually highlighted definitely looks very strong. However, 6 of those 18 units have already been sanctioned to date. And we also anticipate another 4 to be conversions, while 3 units will be upgrades and redevelopment. Major projects to be sanctioned, that has been sanctioned year to date in the region is highlighted, and we are also expecting the Kasawari project as well as the Rosmarjan project are the ones that have actually been sanctioned year to date, while other projects that we expect to be sanctioned are listed here over the 2022-2023 period. However, post-2023, we anticipate major gas projects such as Woodside's Browse to significantly impact the EPC spend profile. So should that project move forward, at the moment, we anticipate that's going to be post-2024 based on the current timeline that Woodside is talking about. However, there are potentials that that project could experience further delay due to the fact that they are currently evaluating a lot of the project economics as well as the introduction of carbon capture storage. The next slide here focuses on the Americas, and we can see here expenditure is predominantly driven by floating production systems as expected, and followed on by your subsea production systems as well as the soft market. Guyana will continue to be a bright spot over the next few years with an FPSO expected to be sanctioned next year, the following year, as well as over the 2025-2026 period. And we've already highlighted the Longtail and the Uraru project accounting for 100 subsea trees. So we expect that beyond the first 5-6 FPSOs, additional FPSOs and associated subsea production equipment would also bolster activities in Guyana or offshore Guyana. However, if you're looking at Brazil, we already saw that the 11th FPSO for the Buzios development have been awarded. However, tenders for the remaining subsea component for that particular FPSO is still ongoing, while 12 units and associated subsea tenders for the 4th phase is also expected to be tendered post-2024. Woodside has also recently announced that it's expected to sanction its Trion project offshore Mexico in 2023, and that was previously anticipated in 2022. But now there's an active tender in the market in terms of the floating production system and associated subsea equipment, so we anticipate that would go forward. Other massive project that we're looking at offshore Mexico is actually the Pemex Zama field. Possibly that could get sanctioned 2023. However, we anticipate that that could still be delayed, putting into consideration some of the financial challenges Pemex have actually gone through in recent years. We also expect the Chinwol and the Pollock project from ENI to be sanctioned in 2024. Shell's Bay du Nord is one of the bright spots in North America, and right now the development timeline is 2024 FID. Whilst we do not expect any standalone development to be sanctioned in the US Gulf of Mexico over the next couple of years, and that is because of the extensive existing infrastructures, it's good to mention at this point that there's a lot of fast-track development opportunities that abound. We also track a lot of brownfield activities, such as the next phase of BP's Atlantis project, as well as potential tenders for brownfield development on Chevron's Anchor project, as well as the Shenandoah project, and those ones we expect will be post-2024. Moving on to the last slide, it's more or less looking at the European market, the Middle East market, as well as Africa. I think we've spoken a lot about the Middle East market in terms of some of the brownfield development going on there. And I think the major bright spot that we're looking at in this region right now, outside the North Sea, is going to be the East Med. We are seeing the Aphrodite project. We are seeing a lot of exploration also going on there due to the need for more gas. So we anticipate that will support and provide additional upside to the 132 billion that we anticipate over the next 5-year period. And we are seeing a lot of gas projects in West Africa as well. So the next stop is going to be Tortue Phase 2 project offshore Mauritania. We anticipate that could be sanctioned in 2024. Obviously, BP is looking at doubling the capacity of the first phase, which was 2.5 MMPTA to 5 MMPTA. And there are also a lot of projects that is under consideration offshore Angola. Obviously, offshore Namibia, there's been a lot of noise around the 2 discoveries that were made in terms of Shell's Graph as well as Total Energy's Venus project, but we don't anticipate any of those projects to get sanctioned until after 2024. However, still offshore Namibia, BW Energy is trying to revive the long-delayed Kudu. We've all been talking about Kudu for a very long time, but looking at BW Energy's record in some of the projects it's developed offshore Gabon, we anticipate that possibly it's time for that project to move forward. Overall, there are a lot of expected expenditure offshore Nigeria as well. However, political uncertainties and change in government could mean that those projects could experience further delays. I think a lot of people in the room here would have been talking about Bonga South for 9-10 years now, and that project is yet to move forward. However, it's currently in our forecast, but we don't anticipate that to happen until 2025 at the earliest. There are talks and tenders around Bonga North, which is going to be more or less a tieback. So relatively, there's a possibility to cut expenditure in that particular development, while Total Energy's Preowei field is also under consideration and could be sanctioned next year. So overall, I'll just quickly have a quick summary of what we've spoken about over the last 10-15 minutes. And that is the supply chain inflationary pressures is causing delays to FIDs as expected, as operators continue to press the supply chain for better commercial terms. Brownfield development in the Middle East has actually brought a lot of optimism, especially for subsea pipelines as well as fixed platform, while throughput capacity for FPSO is expected to reach record levels this year. Overall, subsea tree demand is forecast to average 316 units year on year from 2022 to 2026, with the Americas, which is North America and Latin America, accounting for over 43% over the time period. Overall, offshore EPC contract value is expected to average 57 billion year-on-year over the forecast. However, this is underpinned by the Brent price assumption stabilizing at above $75 per barrel in 2023 and above $65 per barrel over the 2024-2026 period. That said, any questions?
All right, so the rig market then. Okay, so I wanted to just kind of start with this, setting the scene. So where the market has been in terms of rig utilization over the years, and where we are now. So as you can see from the black and the blue line, so that's drill ships and jackups. So you can actually see that in terms of committed utilization, so this is a utilization that actually includes not just rigs that are contracted right now, but those that have work out in the future in which are maybe currently undergoing yard work or reactivation. So those two market segments have now actually reached highs that we haven't seen since 2014. And then the sort of orange, that's showing the semi-sub market. So again, it's an area that we've seen significant improvements in this year. Not quite reached those sort of highs that we've seen in the other two segments, but certainly showing improvement. Now, despite volatility, commodity prices have remained supportive over the year, actually averaging out, Brent averaging out at $105 per barrel between January and September 2022. All right, so looking a bit at the supply changes and how that has affected the market. So starting with jackups on the left-hand side, 153 rigs have been retired between 2015 and 2022. The average age of those retired was 35 years old. So really that was older units leaving the market. During the same time, 110 jackups were delivered over the same period, and there are still 24 under construction. 6 of those have forward contracts in place. There's currently 54 cold stacked and non-marketed rigs with an idle time, an average idle time of those of 6.2 years. Now we're really seeing substantial demand coming from the Middle East. I'm sure you've all heard about, Saudi Aramco, ADNOC, and a lot of the national oil companies over there ramping up their efforts. And because of this, they're increasing rig count. We're seeing increasing amounts of units coming out of yards, being reactivated, and so we're starting to see an increase in marketed supply there. We're actually planning to see 14 more rigs move into the Middle East from Singapore and China over the next year alone as well. Now, in terms of semi-subs, so that's the chart in the middle there, you can really see that massive reduction in supply over that same period. And that was really driven by a severe lack of demand in the semi-market. So 122 rigs were retired. The average age of those as well decreased year on year since 2018, from 34 years back then to just 16 years in 2022. New builds, just 15 semis have been delivered since 2015, so really not that many. And there are currently 8 under construction or stranded in yards, and none of these, as far as we know, have contracts in place. There are 14 cold stacked units, most of which have been stacked for over 4 years. We really haven't seen the same sort of recent increases in supply in this market through reactivations or new builds coming out. And I think that might come in time if we do see the same sort of utilization increases over the next couple of years. In terms of drill ships, so on the right-hand side there, 42 rigs retired during this period. No retirements at all this year, which I think isn't that surprising considering the tightening in that market. Average age of retired drill ships average age of the retired drill ships dropped to actually just 9 years old during 2020, and that was really off the back of drilling companies right-sizing their fleets. A lot of those companies were going through bankruptcy proceedings or other sort of financial difficulties. There's been 21 new builds delivered since 2015, and there are still 15 under construction currently. Of those units that are currently stacked, 15 units currently stacked with an average stacking time of 3.7 years. So that's actually the least out of the three rig types there. So yeah, as you could see from the previous slide, marketed utilization in this segment has really increased quite significantly, but also quite quickly over the past year. So in December 2020, supply was just 76 units. Currently, we're at 82 units marketed, and we anticipate that in 2023, that will increase to over 90 units. However, it is understood that due to cost increases that we're seeing in the market, the price of such a drill ship reactivation could be upwards of $100 million and may take a year to 18 months to get that rig back to working condition. So the reactivation side of things really isn't now going to be a sort of a quick or an easy or a fast option. In terms of contract awards then, so starting with jackups on the left-hand side, 2020 was actually a record low for jackup awards. And during that time, not only did we see a lack of activity, we also saw a lot of terminations and suspensions and things like that. But the subsequent years have really made up for that lost time. Saudi Aramco again, ADNOC, Qatar Energy, Middle Eastern national oil companies have been racing to secure high levels of jackup capacity as they seek to ramp up their domestic supply and production. 2022 year to date, 92,400 days of contract backlog have been secured. And that's just for work in the Middle East, which is actually more than an entire year of 2019 globally. In terms of floaters, on the other graph there, again, some really positive signs in terms of awards activity. On the semi-sub side, the third quarter of 2022 was particularly successful for the North Sea. So we saw 3,924 days of backlog awarded in just the third quarter of this year. So that is the highest number of days secured in a single quarter since the third quarter of 2012. And then on the drill ship side, 2021 saw the highest backlog awarded for drill ships on record for combined new fixtures and declared options. And 2022 is again performing really well, but forecast to come in below last year, but still looking to outperform years 2014 through 2019. South America accounted for 48% of the awarded days year to date in the drill ship segment, and that's shown, in the floating rig segment, I should say, shown by the light green and the yellow on the chart, while the US Gulf of Mexico and West Africa are also contributing significant demand. Now, the fourth quarter of 2022, we're just into the fourth quarter now, has been off to a really strong start, and that really is off the back of Petrobras's recent awards of seven floater awards, which contributes a minimum of 23 years of backlog. And then there was also additional awards of 273 days from other regions as well. And then just looking at some of the other sort of fundamentals or indicators, we should say, of sort of improving or tightening rig market, I should say. So year to date, jackup contract durations are on the rise, very, very significantly on the rise. So there have been less awards than 2019 and some other previous years, but much longer deal durations. This is comparable to the full years on the chart. So obviously we've still got a quarter to go, so this could come down, it could increase depending on the rest of the contracts we see this year. And again, this is down to those 3 to 5 year contracts that we're seeing coming out, and some even longer, coming out again of the Middle East. In terms of the semi-market, semi-duration is, so this is a combined floater one, but in terms of semis individually, average duration year to date is sitting at 271 days, and for drill ships at 390 days year to date, which is actually the highest it's been since 2012, when durations for drill ships reached an average of 479 days. Again, of course, we may finish up a bit lower, a little bit higher before the close of the year. Now, the combined average of floating rigs for contract durations year to date is just 5 days behind 2012, which is the highest it's been in the past decade. Although contract duration is increasing, as you can see, the number of awards per year is still lagging behind. Lagging behind that of sort of those really high years of 2012, 2013, but certainly progress is being made there. And then options, again, another kind of indicator of where the market is. In the jackup segment, we did witness a drop in contract options being taken up in 2019. They started to increase really from last year. However, since this year as well, we've seen them again increasingly being taken up, and there's still over 1,500 days of optional backlog outstanding for contracts which could begin before the end of this year. And then on the floater side, which tells quite a kind of stark story there, options are on the rise, and they have been, options being declared are on the rise and have been since 2015. And if all remaining options on contracts that are due to start before the close of 22 are exercised, total awarded backlog from those options would come to 5,508 days, which is just 21 days behind last year. And with these undeclared options on jackups and floaters, there is potential, obviously, that some of these will lapse. But from speaking with drillers, operators, it does seem that, especially with those fixed price options and the way that day rates are headed, which is upwards, the majority of those will likely be taken up. And then on to day rates. Starting with the jackups, due again to that quickly tightening active or marketed jackup supply, following all the contract awards in the Middle East, day rates for those sort of benign jackups have finally started moving upwards. Most fixtures for these rigs a year ago would have come in somewhere between $60,000 to $80,000 a day. But we're now seeing awards, coming out at over $110,000, $115,000 a day. The harsh environment sector hasn't had quite a jump in day rates as some of those benign units, and that is really down to the North Sea being a little bit flat still. But we've actually seen a number of North Sea harsh environment units being moved out of that region and being put to work in other areas where there is term and where there is those higher day rates. And one of those is the Prospector 5, which you can see there secured a contract with Eni Congo for $130,000 a day. And then on the floater side, so during the summer of this year, we finally saw drill ships break the 400,000 a day for day rates. And then since then, we've seen subsequent rises in rates as well. As we've been speaking about utilization, again, we're expecting that to continue to tighten. Terry's going to speak more on that side of things. But we expect to see further increases in these day rates if there's not a lot more supply brought into the market. In terms of your harsh and benign semi rates, again, showing clear signs of upward movement, albeit at a slower pace. But recent harsh environment rates for Australia and Norway have been pushing those benchmarks that have really been in place since sort of 2019, or for several years, in fact. But we recently saw one quite notable contract come out of Norway, and that was for the Transocean Norge. And if the full term is actually firmed up, that rate will be the first fixed around the $400,000 a day mark since 2015 for a semi in Norway. Okay, and this is just a quick snapshot of some of the sort of tender activity that we have in rig logics. And this is for jackups and then for floaters combined as well. So even without, including in here a lot of the direct negotiations that are ongoing, which we're not often privy to, and which we hear there is a lot more happening. And again, that is another indicator of a very tight market or tightening rig market. The picture still looks really, really quite healthy for rig demand. And that's especially in the Golden Triangle, Brazil, West Africa, the US Gulf, the North Sea and Australia for floaters, and then again the Middle East, Southeast Asia and India for jackups. With the North Sea, Norway specifically, we've been pretty interested to see some operators coming out and looking for rigs for campaigns that don't start until 3 or 4 years from now. And again, we believe that is because these operators do understand that a couple of years from now, the market is likely going to be quite a bit tighter. And that is because some of these rigs are now moving out, going for jobs elsewhere, because the market here is, the market in the North Sea, sorry, I think I'm still in Aberdeen. The market in the North Sea is still pretty flat, although there is a lot of demand coming out from 23 or 24. And so they're not just worried about securing a rig at a decent rate, they're worried about securing the right asset for their campaigns. Now, Terry's going to speak more or do a deep dive into the Americas market, so I won't say too much at this point, apart from it's been a very important market to the floater recovery, but I'll let him talk about that. In West Africa, again, we're seeing renewed interest, which we expect will only be amplified following some of these big discoveries and parts that Mark has spoken about. And then Southeast Asia and Australia are also ramping up in activity for both shallow and deep water projects and for rigs. And they'll definitely contribute their fair share here as well. All right, so just doing a quick overview of kind of what's been happening on the rig emissions side of things. So Gareth mentioned that we've been doing a bit of a report into this, and I've been speaking with a lot of the ET guys, the sustainability guys in a lot of the rig companies, and so we've managed to come to quite some really interesting conclusions, I think, and also get some great detail from you guys. So, the invasion of Ukraine this year, it really emphasized the importance, I think, of oil and gas as a big part of the energy security. And the focus has really been on ramping up domestic energy supply. However, that certainly doesn't mean that drillers have been, they have been slowing down on their emissions efforts. Again, with the report that we've been doing, we've really been hearing a lot about the ongoing efforts and measures. The findings really were that increasing numbers of rig managers and owners are undertaking a variety of different measures, and not just rig upgrades that we hear a lot about, but studies into alternative fuels, attaining green vessel notations from DMV and ABS, implementing training and encouraging behavioral changes for the crews, replacing LED lights, installing fuel and emission tracking systems, just to name a few. And another is, of course, that several of these companies have also been setting their own emissions targets. So they really are serious on this side of things. As I mentioned, low emission upgrades is just one part of this for drillers, but just a quick snapshot here of those we know about. And we do know that there are several also under discussion or planning as well. Now, of course, there is a regional split of where we're seeing demand for these sort of upgraded rigs. Overwhelmingly, it's Norway and it's Equinor, and there are pretty simple reasons for that. And that is the sheer need to reduce emissions because of carbon taxation, regulation, but also there is incentivization from government and from certain schemes such as the NOx fund. And also because of Equinor itself, of course, has its really quite ambitious targets to reduce its own emissions. However, the two second kind of biggest users of low emission or green rigs is actually the Gulf of Mexico and South America. And again, we see this as demand coming from these larger E&P companies off the back of the need to, again, reduce emissions on any way they can to meet their targets too. Now, there are various challenges, of course, surrounding this topic, which has led to slow progress and limited adoption of low-emission rigs for offshore campaigns. These include, high costs coupled with the rig market downturn that, we've just seen. And that's lasted for a long time. Also, the lack of government funding, supportive legislation and regulation, accessibility and availability of alternative fuels, and limited demand for low-emission rigs, or lack of incentivization outside of Norway. However, that doesn't mean there aren't opportunities. So some operators are, of course, offering low emission lowering bonus incentives. Meanwhile, assets with emission reducing technology are often earning a premium on the day rates. And increasingly, we're seeing rig tender documents asking for emissions information, and drilling contractors that can offer sort of those proven eco-credentials will obviously have that competitive edge as well. So that was just a quick overview on that side, and I'm going to pass over to the legend that is Terry Childs. Thanks for listening.
Thanks, Teresa. Thanks, Teresa.
Is that better? Yeah, okay. So thanks, Teresa. So I know everybody's kind of slided out almost by now, so I'm going to, Teresa said I was going to take a deep dive. I'm not sure it's going to be deep, but I'll try and get through this quickly as I can. So everybody in this room knows that North and South America has been, I guess I should get to the slide, has been extremely important to the offshore rig market in the past year, particularly. Particularly the U.S. Gulf of Mexico and South America have been probably the two leading rig markets in the world for floating rigs. The jackup market in North and South America is sort of bears or should have some conversation, although limited, because you have in the U.S. Gulf, I think at the moment, 6 jackups under contract. And as you can see there, and I went back to April 2001, there was 143 contracted jackups in the Gulf of Mexico. So that is a very clear indicator of where that market has sort of deteriorated to, or how mature it is. In Mexico and that jackup market, there's clearly a lot of rigs there. It's an important market in this region for jackups, but with Pemex and their payment issues to contractors and service companies, Carlos, you've heard this, so forgive me, but I was speaking to somebody about the Mexico jackup market recently, and he said it's kind of like being on an 18-month deferred payment program. So, there's certainly issues there, but you have the Mexican contractors are pretty much married to Pemex. There's really not much they can do. They can't really go anywhere else. So activity there will continue, and the contractors are going to have to just do their best to deal with the terms and payments from Pemex. So in the U.S. Gulf drill ship fleet right now, you can see, or actually in North and South America combined, you've got 100% utilization of the floating rig market, or drill ships anyway, 91% for semis, and really just one idle marketed unit there. So we saw the recent 7-rig contract award from Petrobras, although that's only going to result in one incremental unit being added. I've heard estimates of additional floating rigs coming into that region of 4 to 8. So obviously, if that's going to end up being the case, there's still a lot more to be done there. And there certainly are enough tenders to do that. So it'll certainly continue to be a region that we're going to look at closely. Suriname, which I'm going to talk about in a little bit more detail in a few slides, they're up to 3 floating rigs now, including the most recent contract fixture to Transocean that for their DD3 semi, which won't start until January, I believe. So, and Trinidad, of course, there's certainly drilling going on there. So there's certainly other activity outside of Brazil, and of course there's Guyana, which has their 6 rigs, rumors to be a 7th next year, another drill ship. So certainly going gangbusters there as well. When you look at the contracted floating rig fleet in North and South America, you see 37 of 63 contracted through the end, at least through the end of 2023, which is about 70% or 60% of the fleet. So, and we'll see in the utilization slide, or forecast slide, what utilization looks like there. 26 contracts, scheduled not to end until after 2023. So clearly, I think that's quite a large number of contracts to be booked for that period. So it's certainly healthy, and that goes to sort of the day rate situation that we've seen in this region with the scarcity of rigs that's sort of developed, particularly in the U.S. Gulf of Mexico. And as you can see from on the left with the North and South America versus the rest of the world for semis, you can see the bulk of the activity has certainly been in the Americas, which is the orange dots, versus the rest of the world in the black or blue, whatever color that is, and particularly for drill ships. And you can see, especially up in here, you can see the bulk of all the most recent contract awards have certainly been in the Americas and at the highest day rates. There's a few outliers, or not outliers, but a few there in the rest of the world that are in that grouping, but primarily day rates on the high side have certainly been focused in the Americas. Teresa mentioned the U.S. Gulf exceeding $400,000 earlier this year, actually up to $440,000 and $480,000 if you throw in the MPD charges for that rig. So clearly nearing $500,000 if you look at total, total value and so forth. So the recent contract awards in Brazil were not quite, they're still lagging behind as they are everywhere else in the world behind the U.S. Gulf. I think the contract awards in Brazil range for drill ships were maybe 330 to maybe just over 400. So not bad rates by any means, but certainly not in the 440 ilk. And there's been a few of those in the Gulf, in the U.S. Gulf as well, that have come along. So certainly that's where continues to lead the rest of the world for day rates, and everybody else is still playing catch up in terms of that. I'm not going to do a utilization slide for North and South America. As I mentioned, utilization is 100%. I think drill ship utilization has been 100% for the past year. It's not going to change or cease to be 100% for the next year. So and if you're a RigLogic subscriber, which you should be, you can see those numbers anyway, and you can run it and see it, and it's certainly a healthy market, no question. But so in Suriname, and I hope this is the first. I was thinking about this driving on my way over, and I hope this is the first and last time you're ever going to hear professional wrestling woven into a rig market presentation. So some years ago, I was reminded, and I don't know why or how I thought of it. I was flipping through the channels, and I came on a wrestling show, and the announcer was particularly animated, I guess, as they tend to get. And so I stopped for a second, and there was some other I shouldn't say that, some other gargantuan guy running down the ramp, and the announcer excitedly says, "Business is about to pick up," and I guess you could say the same potentially for Suriname, that it's certainly has the potential to be the next big thing, I guess, in South America. We talked about Guyana. I mean, obviously Guyana reserves, as we've probably most of us have read, are somewhere around 11 billion or over 11 billion barrels. From what I could gather or find on Suriname, some estimates for those reserves are about 6.5 billion barrels. Now, there's certainly been, as I was speaking with one of my friends here earlier, Total maybe not moving quite as fast in Suriname as maybe ExxonMobil did in Guyana. There could be reasons for that that we're unaware of, but they've certainly made, there's certainly been discoveries made down there that we've all read about. In terms of our Wildcat product, we show 5 commercial discoveries. I've read about 7 in other places, but we have 2 of those wells that we're not quite ready to go there yet, apparently. So a little difference in that. But we've also seen a couple of dry holes in the mix off in some of that drilling, but it still appears that it's headed to production and in a big way. That was scheduled to start in 2025. Now it seems like it's pushed back to possibly as late as 2027, although most estimates or other estimates say that it likely will be earlier than that. As Mark alluded to, I think in his presentation, perhaps the FID for Total in Block 58 now in mid-2023. I believe Total has already made plans for I want to say 22 well development drilling program down there. So it's there certainly will be additional rigs in Suriname at some point. It really seems to be a question of when more than if. And it's not just Total. There's obviously other operators, 6 operators with 8 drilling programs. Now those are all obviously exploration, so they're shorter term contracts, 1 or 2 wells, but nevertheless, there's still certainly other activity. And as discoveries are made, that of course prompts operators to speed up their plans to drill. So that's certainly forthcoming. Thank you. Also, there's a deep water licensing round coming up this year, and then followed up by a shallow water round next year. So I think Statsoli down there has committed to spend about $1.5 billion in the region. So certainly there's just all kinds of potential for Suriname, and I think it obviously, as I say there, may not be the next Guyana, but could very easily be some form of it. And I just wanted to show the map. This is the drilling that we talked about, that I talked about, the 5 discoveries, and you see it's the proximity to some of the Guyana fields there, some of the oil discoveries, and so clearly they talk about on the same trend and so forth, and this clearly is. So it's not, that's in the deep water. There's certainly shallow water activity, as I mentioned as well. There's been awards there. I think Chevron, Total, and Qatar Petroleum in particular have been awarded shallow water acreage there. So could even result in some jackup work, although I think to call that shallow water is likely still going to require floaters. So I just wanted to sort of just talk about Suriname a little bit, just to as maybe an area to focus on, or that will probably rise in its prominence over the next couple of years. So in looking at rig demand, in the two regions in rig requirements in particular. You see there are nearly 100 rig requirements, plentiful enough to keep the floating rig fleet employed long term. Well, and a lot of that, particularly in Brazil and Guyana, if they ever do have another rig, not so much for requirements, but Brazil, they're all long-term contracts. They're all 3-year, 4-year in some cases. So clearly, as we saw with the 7-rig award, that will continue. They will continue to extend other contracts. So there's really no reason to think that that activity there, and you can see in Brazil 11 outstanding rig tenders from Petrobras and other operators. So it's not just Petronas. We saw Equinor start their recent phase 1, I think, of their field down there, and they've got another rig about to start, I believe, as well. Mexico, surprisingly, despite its issues, they still have quite a number of requirements from several operators. But when I looked at the work, 2/3 of that was for exploration drilling. So obviously, again, shorter term, 1 to 2 well deals. Mark mentioned Trion, and if and when that ever gets up and running, that's a 400 to 600 day, I believe, development drilling program that Woodside will undertake at Trion. So certainly potential to add some rigs, but with the issues that Pemex has had with Talos and everything that's gone on with Zama, I don't know what international operators' appetite will be to continue to operate down there. They don't seem to be really too concerned at the moment. I spoke to a guy with Murphy in Mexico the other week, and they're about to start a well with Valaris Semi, and they're optimistic. So there's certainly things going on in Mexico, and will continue to be, particularly in the floating rig market. We talked about Guyana and Suriname. There's still 14 other requirements there other than what's going on at present, about evenly split between the two countries. I mentioned ExxonMobil with the rumors of the 7th drill ship. Outside of Mexico for jackup activity, Trinidad, of course, has a rig there. There's a few rig requirements that will be maintained, but I don't see Trinidad at the moment as a major source for future rig activity, but it still certainly is a part of the region that is active. So, and I shouldn't forget Eastern Canada, since this is North and South America. There's certainly some requirements down there. There's a contract award recently from BP. I think ExxonMobil will award soon. Could be the same rig, I'm not certain, but certainly not going to be a lot of rigs going to that region, but there certainly is demand there. I think there's still some other operators. And then, of course, you have Equinor's Bay du Nord, which will certainly draw at least one rig, I would suspect. I don't know if it'll be multiple, but so it's clearly not a region that to be forgotten about. But again, you've got a limited number of rigs that can work there just due to environmental requirements or rig requirements in that environment. So, but still, it's a big area in terms of reserves and potential for that. And finally, in the U.S. Gulf of Mexico, there are some requirements out at present. In talking to some of the rig owners, they're pretty scarce at the moment, but then so is the rig supply. There is some rig availability next year coming up, but there's potentially some conversations going on that could fill gaps. But as Teresa sort of alluded to, the Gulf of Mexico is a little harder with tenders and rig requirements because you don't have public tenders and so forth like you do in some other countries or regions. So it's really a lot of word of mouth for us, to get this requirement data. But there is work there, and then some other short-term work, some P&A work, and some other workover type things scheduled as well. So I've been told in the Gulf that 2023 is almost sold out in terms of rig availability. There are a few rigs, I think, that do have some, as I mentioned earlier, but I don't I don't think you're going to see too much idle time, and I think you're going to start to see some of these drilling programs are going to start being for early 24 starts, because there's just not a lot of availability for next year at this juncture. So it's moving out, and of course with that obviously will come a rise in day rates, and I'll talk about that a little bit more at the end. So just looking at some of the demand indicators, again, another one is the subsea trees, and of course Mark has been over that quite thoroughly. I just threw this in to have another slide. So you can see the level of installations there in the, is that orange or red? I guess it's orange or red. For fourth quarter 2022 and then 23, you can see the levels are all similar to the 2019, where we had a pretty good bit of activity. So it certainly looks good. And in terms of regional activity in the pie chart there, you can see the main regions being the North Sea, Latin America, or West Europe as it's called on this, Latin America, and North America. So including the North Sea, which, as the term that I heard earlier was the golden quadrangle now, thank you, Lauren, instead of the golden triangle. So the North Sea, obviously, as Teresa talked about, for semi-demand and so forth, is going to be very strong as well as other regions, but Africa, South America, and U.S. Gulf are clearly amongst the largest drivers for floating rigs going forward. There's no question about that. And by the subsea activity, you can see that those regions again are where a lot of that activity is going to be centered. So all the factors are in place for continued high utilization, and so that gets us to the floater forecast. Now, this is just out for next year. I said potential supply shortage looming, utilization at or near 100% for the near term. You see it says 119%. Well, obviously you can't get 119%, but that's just to illustrate that there could possibly be a rig shortage. Now, for a lot of these contracts in Brazil and a few elsewhere, we've seen rigs brought out of the shipyards and reactivated drill ships, and that will continue to be the case most likely because there's just not, I think, of drill ships right now, marketed drill ships. I want to say, if my memory serves me correct, there's only five or six marketed drill ships available globally right now. So there's going to have to be some come from somewhere else. And so there's still some in the shipyards from construction, but it seems that most to this point have taken the route of reactivation versus trying to bring out a new build that's been in the yard for 6 or 8 years. So the only problem with the reactivations is the time now. It's almost up to a year for reactivation, and the cost is approaching, I'm told, $100 million or so. So a lot of these programs that if an operator doesn't have a rig, he may have to move it into early 24 just to be able to wait, just to have to wait for a rig to get ready. So if that's the route they're going. So, but basically, I think what you see with the solid line that goes down, and that just shows what would happen if nothing else happened. That's just current contract end dates and so forth. Well, utilization is already at 70%, even with nothing else being added. So when you model in other demand, rig requirements, look at subsea, et cetera, some of the other factors, that's what obviously has gotten us up to the 95% we're at now, and should get us up to that or near 100% going forward for the next year. So certainly no reason to think that the current level of rig usage is going to slow down anytime soon. And lastly, for jackups, obviously a lot more rigs in the jackup fleet, so it's harder to make utilization move sharply, I guess, as you might see with floating rigs, but we think utilization will remain decent. You see there, we've got it going to up to 84%. Pemex situation that I spoke about could pose some challenges, but essentially with jackups, it's, you see how it's going to go down. It's into what, 20% or so with nothing else happening. So obviously there's a lot more short-term jackup contracts. Now, the Saudi Aramco ADNOC offshore situation in the Middle East has done wonders. That I'm not going to say has saved the jackup market, but it's certainly done a lot to boost that market for sure, because there's been probably close to 20 jackups, I would say, that have been bought and are now undergoing reactivation for long-term Saudi Aramco or /ADNOC offshore contracts. So the Middle East obviously will continue to drive the jackup market by far. I think when it's all said and done, you'll see close to 175 to 200 jackups alone just in the Middle East. So, but in terms of North and South America, Mexico, of course, is the biggest jackup user, and so the future is as murky as it kind of seems, just because nobody can get paid on a regular basis. Still, Pemex doesn't have a choice; they have to keep drilling. So, jackup usage will be maintained, and 85% utilization. It's said now that 85% is the level that's needed, utilization level needed for day rates to really start to move significantly. Now, we've seen some of that. Teresa pointed out the 130,000 in Africa, I think it was, and some of these Middle East contracts have also, rates there have now exceeded 100,000, and probably 120, I think, is maybe the highest that I can think of off the top of my head, but Mexico, not so much. Now, Pemex did apparently raise, they have a ceiling on what rates can be bid, and I understand they did increase that, but not by a lot recently, but still rates in Mexico are not anything to write home about versus what's happened in the rest of the world. Now, in the U.S. Gulf, with 6 jackups, essentially every jackup in the U.S. Gulf of Mexico gets the same day rate. It doesn't matter what water depth it's rated for, what the design is. If it's a mad independent leg, they're all pretty much in the same day rate range, which has moved substantially. They were at $65,000 a day for a really long time. The last most recent fixtures are now at $85,000 a day, and there's anecdotally I've heard 90, something with a 9 in front of it, is, if it hasn't been fixed already, is not far off. So there's only a handful of operators in the U.S. Gulf that drive jackup activity, so and that will continue to be the case, with a few other operators coming out that'll drill a well or two a year, and will pick up a jackup here and there, but basically it's Arena Offshore and Canium and a couple others that dictate most of what happens with jackups in the U.S. Gulf, so that'll continue to be the case, but with 6 jackups, that's at this point plenty to handle whatever demand comes up here. So there's no reason to think that won't be maintained, and we should, as I mentioned, see some rate increases there as well. So doing an overview, and this is kind of sort of a global one, not just North and South America. As we've kind of talked about, the fundamentals are all showing signs of a continued recovery and continued strengthening. As I talked about, drillship demand will continue to be driven by the Golden Triangle, semi-activity in the North Sea, and as we mentioned, Australia is a good market for semis, and Southeast Asia not as much, but to a lesser degree. We believe, particularly in the North Sea, that Norway semi-use will pick up in the second half of next year. We've seen some of the semis in Norway go to Africa, and a lot of them have been marketed into the UK sector, but we believe activity actually off Norway will pick up next year. Jackup usage in a different part of the world, whereas the floaters are focused in the Golden Triangle, as I talked about, jackup usage is more east. India, Middle East, Southeast Asia is actually improving quite a bit. So those markets dominate at the moment the jackup fleet. So high levels of demand, as we talked about, in those markets, and Southeast Asia is starting to really improve as well, as I mentioned. So day rates continue upward movement for all rig types in all region. As we talked about, the U.S. Gulf remains the setting the pace for drill ships. As I said, other regions are improving, but still lagging behind what's happening in the U.S. Gulf. Same for semi-day rates in the North Sea. They're certainly improving, and as I've also talked about, jackup rates noticeably higher in those primary regions. Teresa talked about the contract duration extending, and it is for all rig types at highest level in the past 10 years. And that's a lot, again, thanks to the jackup fixtures in the Middle East and the South America floating rig fixtures. As I mentioned, all the Petrobras deals are generally 3 or 4 years, so that certainly pushes up your contract durations at a pretty fast clip. But the Saudi Arabia contracts have all been a minimum of 3 years, and most of them 5 years. So clearly, that's where the bulk of this backlog is coming from. She talked about drillers continuing emissions reduction efforts. North Sea and U.S. Gulf of Mexico companies, drilling contractors and operators in particular, leading the pack or having the most activity in that area. So I think that's all I have. I tried to just kind of hit on some high spots here. Obviously, Teresa and I, our colleagues, Kath also in Aberdeen, and Paul in Singapore, we're certainly happy to talk about the market anytime with anybody. If you hear a rumor you want to run by us, or just chat about something you heard or what we think, we're always happy and available to speak. So to speak with you. So that's all I have, and we'll take any questions about any of the presentations now. Am I right?